Hi, Steve Van Metre here. Welcome to your Monday Night Premiere. We take about 15 minutes every Monday and Wednesday night trying to make sense of markets that really don't make a whole lot of sense. Now, let's talk about the bond market. Last week, I noted on Friday that the Treasury yields were holding resistance, overhead resistance, meaning they went up and they just couldn't pass. It's been a level they've seen before, and they started to move lower. And all of a sudden, last night, right as the European market opened, it was just like someone slammed them straight up. And on what news? Okay, well, China's cut interest rates. Big deal. It's not going to work this time. There's a dollar liquidity shortage. Not going to matter. And then China's going to send their chief negotiator to sign the phase one trade deal, which none of us have any clue of what it says. But apparently that's coming maybe as early as Saturday. But Europeans were dumping bonds. We also know, we heard this from Nomura last week or the week before, that their quant models, which aren't the only quant models, but we'll assume that they're very similar to the other quant models, are almost done selling. This is why if you've looked at a bond chart, you'll see they go up and then they sell down. They go up and they sell down. Those computer models are coming in and we're selling what's called selling the rip move higher. And then they're turning around and buying stocks on the dip. So you're like, well, stocks dip, and all of a sudden buy. That's the other version of their quant models. They're buying the dip for now. And one of the things that I expect to happen, and I don't know if it's just because of the delay, the way the holidays are falling in the middle of the week, but a lot of these pension funds and institutional money managers, mutual funds who manage diversified portfolios where they have a certain percentage of stocks, certain percentage of bonds, they'll need to rebalance because over the last 3 and 6 months, stocks have outperformed bonds. And when you run a 60% stock, 40% bond portfolio, and you're at 65-35, well, according to your investment policy statement, you have to sell stocks to buy bonds. And so they should be. And we're not really seeing that in the volume. We're not seeing that yet in the price. So I don't know if it'll happen all tomorrow, because I know a lot of Wall Street traders have been just gone, or if it'll happen next week after the first year again due to the way the New Year's, where Christmas and New Year are hitting in the week. I don't know, but I do expect that, and that should push bond prices up and stock prices down because there should be quite a bit of selling from that. And I do want to talk about the price gaps, and we'll get to that in a little bit later. Because someone came in recently, and again, the great thing about this video is we never name names, and he asked me to explain the price gaps, and I thought, well, maybe it's something we should go over and how that works. And there's a lot of gaps in bonds and treasury yields, and we need to look at that. So right now we're seeing heavy selling, or we've seen heavy selling in the bond market, and that's kind of a good thing because once all the selling is done, then what's left? The price goes up. And what's interesting to me is you have the second largest speculative short position in the Treasury futures market, maybe the largest. And when we get the report, now we're not going to look at the hedge fund position day because of the way due to the holiday last week. That report's coming today, and I don't have it because the guy hasn't run it yet. So we'll look at it probably Friday because Wednesday is New Year's and that's a holiday. So there'll be no video because there won't be anything to talk about. But nevertheless, you have heavy selling out of Europe from the quant models, from hedge fund managers, other speculators. And what has happened is there hasn't been that big of a drop in bond prices or a big rise in treasury yields. And that's telling you that somebody is buying up all the supply. Now, we know the large commercial banks needed this. And we also know the Fed, who is buying $60 billion a month of treasury bills, is pulling up a lot of the supply. And once the supply is gone, then you'll see prices start to shoot higher because all of a sudden people will want bonds and then there won't be any to buy. So what's driven all the speculative selling and pushing the bond market? Well, earlier this month, and I'm going to cover it in much more detail in the Friday in the written part of the update, but a guy by the name of Zoltan Pozsar, which I may be saying it wrong, and yes, that is his name. He's a managing director of some really important part of Credit Suisse, published a report on the repo market earlier this month. And this guy is probably the expert in the repo market or the overnight dollar lending market. And he said, we said not a guarantee, but based on his understanding of the situation, that there could be a massive spike in Treasury yield because the banks would be forced to sell their bonds. Now, I didn't buy into that because I know the banks need collateral for their portfolios, and they need Treasury securities. Because if you look at how different assets are scored, according to, I was going to say Bureau of Labor Statistics, but that's Bank of International Settlements, BIS, not BLS. The gold standard of collateral is Treasury securities. Second level is mortgage-backed securities. So the banks have been buying this. So it wouldn't make sense for the banks to be buying all of these assets and then only to turn around and just dump them in the last couple of weeks of December. But I understood his view and I respected that. I just didn't see how it was going to pan out. And he was saying that the banks would need to do this to lower their GSIB, or global systematically important bank score, by the end of the year. And this kind of leads me to believe the Fed fabricated some of this liquidity crisis. Now, I'm not saying this entirely fabricated. What I'm saying is there is a liquidity crisis. My suggestion is a couple weeks ago, the Fed raised the limits on their overnight and term loans because there's going to be a year-end liquidity problem. From what? Corporate tax payments in the middle of December that is not a new thing? Estimated tax payments for other people on January 15th? No, it was to get around this GSIB score. And this is how they did it. This is my opinion. I cannot validate this with absolutely any facts. Is the Fed took on loan, which is what they do with these term loans, Treasury securities from the banks and mortgage-backed securities from the banks, and then they floated them the cash, which is more helpful for their GSIB score, and they floated it into January. And when we looked at the bank data on Friday, you saw that, man, they dropped their Treasury securities by almost $50 billion. But you don't see $50 billion in movement in interest rates at all. Why? Because transferring to the Fed's balance sheet is not a sale. Pretty slick move. So there was an article that was published, I want to show you, on Zero Hedge today from Northman Trader. Now, just so you know, that Northman Trader, he is a technical analyst, and you can, if you go to zerohedge.com, you could read his articles called "It's Not Over." And now, I'm not endorsing him. I do not pay for a service, although someday I keep thinking I will, just because I respect the work he does. And he was talking about TNX, or 10-year Treasury yields, showing a bear flag. Now, you've heard me talk about this. He said if there's an evidence of reflation trade to come, it's not evidence in the chart. Now, again, he follows the chart and the charts and then looks at the data. Now, he says this is not confirmed until it shows confirmation, but that should happen. Now, the pattern has room higher for the 10-year, could even go into 2.1%, but it suggests that a breakdown will not only invite a retest of lows, but even new lows. And you've heard me say that. And he said, so let's look at that chart, which I have here, and I can't really zoom it in any more than it is, but here he's showing this is what a bear flag looks like. You see prices come down, the angle up, and what's happening here is buyers are coming in and buying up all the supply that's being dumped on the market. I mean, again, you have a huge amount of Treasury securities that are being dumped onto the market, and the market is absorbing them. So what does that tell you? The people want them here. And he goes on to say TLT, position I hold in many of my portfolios, is one of the strongest, most consistent trends out there. It's rising. And he says somewhere down here, let's see, a bullish flag. There you go. Suggesting that reflation celebrations may be premature, as I have said. And he said, if anything, this chart suggests if the pattern confirms and breaks out higher, we may see a run back to the top of the upper trend line, or, as I've said, new all-time highs for TLT. Now that chart is here, and you can see there's that bullish flag that I pointed out, and looking like it's getting ready to move in reversal. So I think that's really interesting. Let's take a look at the NASDAQ McClellan Summation Index really quick to show that the markets are forcing liquidity higher, but they're forcing it. And what's happening is hedge fund managers, believe it or not, now if I sound funny, I'm still getting over that cold. I'm in that foggy phase where you're hoping it's about over. Your voice sounds funny and you can't think straight. So what hedge fund managers have doing to force liquidity in the market is they can actually access the Fed's overnight and term lending facilities. I know you're saying, wait a minute, hedge fund managers can get bailed out by the Federal Reserve? Yes, they can. I'm not saying I agree with it, just saying this is how it works. So hedge funds do own lots of Treasury securities. As a group, they're one of the largest in the world. So they're loaning those Treasury securities to the Fed for cash. Take that cash, you buy stocks. Now there's a problem. We're in a dollar liquidity, well, not yet crisis, but we're in a major the largest dollar liquidity crisis in history. I guess it's not the right word, but you get the idea. Longest dollar liquidity contraction in history. So the hedge funds are chasing stock prices higher so they can bill their fees because they've underperformed the market this year. But they're swapping those Treasury securities with the Fed for those dollar loans. Now, what's going to happen in January when the economy or the financial system is still not creating enough dollars? Well, they're going to have to repay those loans with dollars. Fed doesn't accept stocks. They're just going to have to sell their stocks. And if they sell those stocks and bond prices start to rally, they're going to have to sell even more stocks because they're very, very deeply short the bond market. You see how this turns into a massive problem? And so when we look at the dollar liquidity issue, you see this is a chart of total federal debt held by international investors and the monetary base. So this is world dollar liquidity in blue on a year-over-year basis. So here you see the largest contraction in the history of world dollar liquidity. So world dollar liquidity, for those who are not familiar with this term, because we're no longer on the gold standard, we are on the dollar standard. And this measures the rate of growth of dollars in the global economy. And to keep a debt-based global economy expanding, you need a continuous supply of dollars, somewhere around a rate of 20% a year increase in dollars. And so here's the largest contraction in history, and you can see periods of contraction lead to recessions. And I overlaid the trade-weighted dollar in goods. And right now we're seeing people selling the dollar, hedge fund managers in particular, to try to push gold higher because they think the dollar is going to crash. And what you see is due to the dollar liquidity issues, even though world dollar liquidity can rise here, the dollar still gains strength. Now, why is that happening? It's simple, because the only solution to world dollar liquidity is either foreign investors, mostly foreign central banks, start buying more U.S. Treasury securities, which they're not, they haven't been, or the Fed pumps money into the system through the monetary base, which goes to the banks, which gets stuck in excess reserves, meaning it doesn't actually get anywhere. So the dollar liquidity crisis actually persists until the system kind of gets restarted. So we should see a higher dollar here, a much higher dollar here, because of the contraction in world dollar liquidity. So I think that's very interesting. Let's go take a look at some charts. Let's stick with the bond charts. That's where I want to spend most of my time. Make sure you're on the right spot. You are, and cool. We'll get this loaded up for when we're done. All right, there we go. All right, so here is 30-year Treasury yields. There was a small gap here. It has now been closed. Every overhead gap in 30-year Treasury yields and 10 years are now closed. There are no more open gaps. However, there is a gap here, and there are gaps all the way along down in here, and all the way back to the all-time lows. You see this gap right here? Has not been filled. Now, what is a gap? Let's think of a gap as you're in a major sporting event and you didn't bring a car, you got it dropped off, and you're walking out and you want a ride share to go wherever you're headed, hotel, home, bar, friend's house, wherever, right? And so all the major ride sharing companies raise their prices. I don't know, they have a special name for it. So they raise their prices to encourage drivers to come there and pick up passengers and earn a premium. So that would be a gap up in price. So let's say the drivers say, hey, I want to go pick up people from this big sporting event and I want to make extra money for my trouble of dealing with that. That is a gap up in price. Now, there are people who don't want to pay that gap up in price. So they might say, hey, you know what? I'll wait a little while. I'll maybe just go down and have a drink, or I'll go do some shopping, and then I'll pick up a ride share later. So you see a gap up, and then what happens is that gap will fill later as the drivers come back around to pick up the next round of people who don't want to pay the price to leave right now. So that would be an example of a gap up in price. And then the reason it fills is just because the market's got to come back down and pick up everybody it missed. So the driver's got to just swing around, and price will go down until all the passengers are picked up, and then things go back to normal. A gap down would be that, let's say you had 500 people that want to ride and you had 1,500 ride sharing drivers show up. Well, all of a sudden prices are going to fall because some of those 1,500 drivers are going to say, I'll just wait it out. Some are saying, I want to get out of here, but I'll take somebody with me. And some are just going to leave. So prices will fall until enough drivers disperse, and then it'll come out back up to normal pricing because there won't be any demand for above average bill. So that is an example of a gap down. But again, prices have to come up to eventually fill that. So when you see these gaps in a chart, they're going to get filled. Now you can see this today in the overnight chart here. Let's go to the 10-day chart here. You see this boom, gap higher. This gap will get filled because there are buyers or sellers in here that the market wants to go find and figure out. And here's a gap here that needs to be filled. There is a gap here to here that needs to be filled. If I counted all of them, there's probably at least 8 or more gaps all the way down to right near the all-time lows. And so what's important to understand about gaps is they are like a breadcrumbs. So the market's leaving you clues of where it's eventually headed. Now, if you just saw one gap by itself, it could be years before it gets filled, but virtually every one of them does. That's what's really weird about it. They eventually all get filled. When there's a lot of them, as there are in Treasury yields, it tells you that maybe in the short term, yields will continue to rise a little bit, but the general direction is they're going back down to their all-time lows. As we've looked in past charts, the last 2 all-time lows in Treasury yields that no one thought would ever be seen again left a gap right at the lows, and they were both filled in the years that followed. But this time there's like at least 8 or more gaps all the way down to the all-time lows, and they will get filled. So the market's telling you the general direction. The chart pattern that Northman Trader identified is telling you the correct direction of bond prices and Treasury yields. It is what is going to happen. So anyways, let's just wrap this up. Went a few minutes too long. But anyways, I appreciate you taking the time to watch. And as always, the content of this video is provided as educational information only, as not intended to provide investment or other advice. Materials not to be construed as recommendation or solicitation to buy or sell any security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in the video that I do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.